Hi, everyone. Thank you for joining us today. I'm Marche, the webinar director at Advice Chaser. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation. Attendees are muted, but we do encourage you, go ahead and ask questions using the chat box. We'll be monitoring those during the webinar today. And we also have a question and answer period at the end. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well. We'll make sure someone reaches out to you after today's event to make sure that gets addressed. Once again, we want this to be as educational as possible. Please don't hesitate to reach out for clarification or expansion of the material. Well, I'm going to go ahead and introduce our presenter today. John O'Bannon is a financial advisor with Diversified Financial Group, working closely with his clients and their CPA, attorney, and other professionals. John helps to design prudent financial strategies specifically tailored for his clients, family, or business, assisting with retirement savings so you have more options when you retire, creating a strategy to pay for expected education expenses, and partnering with business owners in evaluating their business retirement plans and their transition strategies. This is what John does. John has enjoyed working with a variety of clients over the years, and he's made most impact with small business owners, women post-divorced or widowed, professionals, and executives at local companies throughout the Midwest and across the nation. John, we're so excited to have you here, and I'm going to go ahead and turn the time over to you.
Fantastic. Thank you so much, Marche. Thank you very much for having me. Welcome, everyone, whether it's morning or afternoon, where you are. I hope the first half of or the first quarter of the year has gone well and smoothly. And really today, we're going to dive right in with an idea that I think most people wonder about. I wouldn't necessarily say they struggle, but it's certainly a topic of mine, especially when on the news, everyone hears markets going up and down. You may or may not see your financial statements go up and down after the last 2 years, where we've seen nothing but growth. But long term, what does that really look like, and what does that really feel like? I think when we all started our careers and families, we always had a thing called insurance that protected us if we were to die too early. Meaning, right, you've got a family, a house, car, student loans, whatever that is. If life were unexpectedly to go the wrong direction, all of those things would be covered, right? And if you have significant other, hopefully that life insurance then also allows that other person to carry on as the two of you had dreamed, at least for an amount of time. So then we get into the point in life where it shifts from you've worked a long time, you've saved your money, you've done the things prudent to create a nest egg, as they call it. But now what happens if you die too late? And that's kind of a strange phrase for most people to hear or to think about. But it's very, very real. Really, at the end of the day, what happens if you run out of money? Simply. And I think putting specific context to that phrase and not just using a broad phrase, running out of money could happen for lots of reasons. Maybe you just didn't have a big enough bucket. Maybe you had healthcare events. Maybe just unexpected life changes brings you to zero. And what we want to do is to plan as best as we can, long term, that whether we live as long as our parents or longer, we're covered. Statistically, our generation is living longer than any generation before. We are also, because of that, working later than any generation before. A lot of that's because we're able to, we're healthier, we want to. Just, turning out the lights on the last day when we retire and calling it a day, and never to do anything ever again, that's just not in our DNA. We have to continue to work. And sometimes we honestly need to work, not only to keep the lights on sometimes, but also more times than not, it's actually to pay for health insurance, where that gap before Medicare picks up the portion, right? It's still not free, but certainly it's much more cost effective than if we were to go out on our own today. As a general rule of thumb, the income that you make today, about 60 to 70% of that total gross is what you're going to need for that 20 to 30 year span of retirement. Where does it get that number? How does that work? Certainly, Medicare fills some of that gap, or excuse me, Social Security fills that gap. But quite honestly, after all those years of paying off debt, being frugal, your costs drop. And it just doesn't take as much to live life when you had a full household beyond yourself.
I have a question here,
Yeah.
John. The question was, does that also account for inflation? So that 70% of your current income, obviously, inflation will go up over the years. Will that account for that?
Great question. It does. And it's really one of those things, if we keep taking the same number and we grow your number. So let's just say you make 80,000 this year or 50,000, doesn't really matter. And we say 10 years from now, with the same rate of inflation, that's still the number. So in your mind, it's harder to do without certain projections, but know that your bills, if your annual costs for the household are 40,000, 75% of that's, 30 grand. So 10 years from now, give or take, that's going to be 35 grand with, inflation. Some of those numbers are obviously loose, but again, don't get too caught up in those details. In that, with those kinds of projections, Social Security will follow, typically slower, but they will. And some of those other things, as your assets continue to grow, that's why when we talk about rate of return, that kind of matters. But without getting into the weeds, yes, that 60 to 70%. More importantly, in that though, individually, is what kind of lifestyle do you live today, and what do you want? And if we go one step further, typically in retirement, the first 5 to 8 years, we call it the go-go period, where you want to go do things that you've never done before. You save for 25 years, you finally want to go to France, or you finally want to buy the motorcycle, or you want to buy the piece of land, whatever. Then you have a period of whatever number of years, 5 to 10, we'll say, that you are still going and doing things and seeing family and seeing friends, but it's certainly at a slower rate. Part of it's because your body wants to slow down, but part it's like I'm good. And then typically then is the no-go period. And that's for the long-term care. And your body just literally says, we can't do that. And some of you may have been helping mom and dad. You've seen these progressions and you understand how the money plays into some of those stages. And so your 60 to 7% isn't necessarily a stagnant number. It certainly will vary, But if you average over 15, 20 years, that number kind of holds true, right? And so moving then to the next, in that planning is really, we talk about the long-term care because of those end-of-life challenges. We talk about medical needs that you may have because of family relationships and genetics. Of course, maintaining your standard of living and paying your current bills. And, do you pay off your house, or do you continue to pay on it, as it is? All of this, though, really boils down to, we are no longer having to plan until you're 75, which I think most of us growing up, if we said, man, we're going to make it to 75, that's old. We've really seen statistically the average for a male is 83, 84. And still for the female, it's a few years older. So we're talking 86, 87, 88 on average, right? You're going to have some plus or minus, but we've dramatically increased the timeline that we need to plan for. On top of all of that, we all want to have some sort of mark and meaning on the world that we leave behind. And certainly there's always the conversation if we want to leave to the next generation, or if we want to give money to charities or, things that are special to our heart. We plan for those things too. So it's all of these things are in the buckets that we try to manage and we try to fill. And then we try to back it up to say, well, how are we going to pay for all those buckets? What tools do we use to do and execute those things? And typically we start with 5 or 6. Some of these tools you'll have today, some you don't. For those that have more financial need, ability, some you'll have different levels of complexity. But if we boil it down, 5 to 6 really generic tools is what you have, right? You have your regular income, your job today. Pretty simple. That also includes maybe you've got a business, whether it's a side hustle or you literally own a business. How does the sale of that work? Because at some day that income stops, just like it does for someone else, but the taxes. And so we talk through some of those things. But also, what happens if you just have a bunch of rental properties? Is that income you're going to keep for a long time or a short time? Or what if you have a family farm that you get rent from? There's so many different pieces that fall into this income bucket. Some people have it, some people don't. That's okay. It's still the same tool. Of course, we talked about briefly just the savings or emergency. Again, a couple grand. If you don't have the emergency fund, again, a couple grand. That is absolutely the number one priority before you hit retirement. And I would make the case, if you don't have it today, that is your number one priority to fill that, because it makes the rest of life just a lot less stress-free. I call that, sleep at night number. Whatever it takes for you to sleep better, that's the number it should be. Some people more conservative, that's 10 grand. Some like, no, I'm pretty good managing my money, 2,500, 5 grand. Great. Whatever that is, write that number down and work toward that, because it's really critical, especially when you become retired. The typical bucket of all things called investments, CDs. Yes, less and less people have them now because rates were so horrible for the last 3 years. They'll start to climb, but it's conservative dollars. Typically your 401ks and IRAs, 403bs, all the same kind of number. The way they act, the IRS just puts a different code number by what your employer is, but it's really all the same type of asset. You're going to pay full taxes on those dollars when you pull it out. Bonds, stocks, alternative investments, that is going to be, maybe you own real estate itself, or maybe you have dabbled in some of the digital currency, all kinds of outside the box investments that are valid. They just don't fit in the others. But all of that is your investments. And we look to that tool, if you will. How do we change its growth rate versus how much can you drip off of that to create monthly income with dividends and so on? But that whole bucket is treated the similar way, right? We'll jump to Social Security. We all understand that's where it is today. I'm an advisor that believes it will still be around for us, only because it's political suicide for our leadership to let it go under, right? Will it be the same as it is today? Probably not. They've already started to change. When you become fully vested, they'll probably continue to do that. As if we continue to age as a society, they'll continue to move that number. Maybe the percentage you're able to pull off of your assets, it'll be around. But I've always said to a lot of folks, including myself, but treat it like it is on you to pay for your own retirement. Have that be the bonus. And really, even if you could just get your Social Security just to pay for your Medicare, that's a win, right? And I put the Medicare on this because it's not so much free, as we all know, but Medicare drastically drops the cost of living and everything else. So that's why it's on here. I only call it out, not so much as that it's an income stream. It's certainly something you pay for, but it dramatically drops your exposure for bills. Less and less. Another tool is pensions. Used to be up near 30% of America had a pension, and now it's down to about 7%. With dropping unions, it's certainly very, very rare that corporate or individual employers are sponsoring pensions because of the legal liability. That's probably going to drop to somewhere near 4% in the next 10 years. It's not a surprise. Those that have them, good for you. That is a huge, fantastic asset. And those that have served in the military, you may have VA benefits. All of these tools are ones that some people have, some people don't. None are right, none are wrong. How big some are versus others, it's just in all assets in the universe, it's pretty much boils it down to all of them, right? And that's great. So the one thing that we don't necessarily always consider as a tool to pay for things is insurance. And it kind of goes back to where I started before. Originally, it was for the original use if we died too early. Now it's to die too late. And 25 years ago, when long-term care first came out, and then there was whole life insurance. Whole life was to kind of create maybe an income stream for you down the road to be almost like your own pension. There's good and challenges to that. But long-term care, when it originally came out, it was a use it or lose it. Kind of what I call is kind of a failed lottery ticket, in that you're holding this ticket, and if things go bad, you kind of win the lottery and they pay for your bills, which is kind of a bummer. And the good side is that you have a healthy life, and we pass on in life like we hope, but then you just wasted all of this money. So
I have a question
go
here
ahead.
really quickly. So someone's asking, so in the past was long-term care insurance more like term insurance, term life insurance, where
Yeah, it's very similar, right? So you put the money into it, and unless you used it, it was gone, right? The only difference was that long-term care doesn't have an end date. So you could be 95, still alive. As long as you were paying on it, that's fine. No big deal. And they understood that, the insurance companies did, when they signed up that original policy, right? So now the flavor has changed, that this insurance, just in general, because of the baby boomer generation aging the way that it is, it's demanding more from almost every industry it's touching, certainly insurance being one of them. Long-term care now has lots of different flavors to it. You can think of it almost as like a Swiss Army knife, where long-term care used to be just the one machete blade, that was it. Now, your long-term care typically has some sort of growth component to it, where let's say if you had $50,000, you put it to this long-term care policy, and maybe it grows to 85,000. Or another version, you put 50 in, day one, it's worth 100. And then over the next 15 years, maybe it grows. And if it grows beyond 100 or whatever that might be, you get the better of the two values, but sort of like regular insurance, the face value is 100,000. So it's got this kind of variation to it. But the additional kind of a third variation is that almost all long-term care also has now a death benefit, where if you never use it, maybe you get your 50 grand back. So return of premium is what they call that. Maybe there's a face value. Maybe it's like 100 grand. Either way, those dollars now become tax-free to your estate. So it kind of brings in some of the tax conversation that we'll have in a bigger plan, at the bigger discussion, not necessarily more money plan, but just a bigger discussion. It certainly takes away maybe a blind spot or a concern for your health. Another variation for long-term care is if you have a spouse, there are ways that both of you could be on the same long-term insurance. So if either one of you were to have that, then one or both of you could use those funds. So again, this whole tool has dramatically changed in the last 5 to 10 years. How it works is part of the bigger conversation, but our discussion today is really also centered on how do you pay for it, as well as all of these other things. And that's what we're here for. So let's say that you don't have this ability today and you're 50 or you're 55, or you could be even 60, right? But maybe you still have a few years left of work. So instead of just saying, well, I'm working to the end day just so I make it to Social Security, maybe those last years you also say, okay, now I have this other understanding, awareness of a long-term care. I want to make a goal to, create a $50,000 bucket or 100,000, whatever that might be. And because I have time left, I still have that opportunity. I'm not just going to put my time in. And some people will say, well, then I'll actually have a second job just for the insurance portion, because I know that probably I'm going to need it because mom had Alzheimer's or dad had, cancer, and it's in the family. So it's just one of those things that we talk about now, while you still have all of these, steps yet to go in front of you. So the long-term care leads into just the insurance tool conversation, because it can be somewhat complex, as I've kind of gone into it a little bit here. But your financial planner in this conversation of 10 to 15 to 20 years really should talk to you also about taxes and how those are affecting you long term. And the tool that I think that gets really not near as much cred as it should is insurance, because you can take this asset that, again, when we were 30 or 40, we only saw it as the one thing that's going to protect us from all the other things going bad. Where as now we turn into 60, 70, 80, insurance becomes a tool that says, how do I convert my taxable dollars into either tax-free dollars to my estate, or how do I use it to set off taxes? So insurance really becomes something of one of the most complex tools that we work through and we talk about. And truth be told, I don't love insurance in general because I like insurance. I like insurance because of what it can do as a flexibility option for you. Sometimes it's perfectly applicable, and other times it's not. But it should be something that you at least consider. So for example, right, let's say that you had 100 grand in your 401k or your IRA, right? When you go to pass that on to your beneficiaries, $1 of that is taxable to them, right? And the rules just changed in 2017 when the previous administration changed the rules that prior to that, your beneficiaries, let's say you only have one kid, and that prior to the rule change in 2019, you had the rest of your life, and you guys may know this with your own parents. If you got a 401k from them or an IRA, and you got the rest of your life to take those dollars at your tax rate today, that's 30% or whatever that might be. The new rule in 2019 says the government has been waiting for 30 or 40 years for those tax dollars since you've been working. We want those taxes now in 10 years. So go back to the one beneficiary and 100 grand, you've just increased their income by 10 grand every year. Or you can take a lump sum. Either way, you've dramatically changed their taxable liability. 100 grand isn't a huge thing, but if you get to 300, 400, 500, which I think a lot of people assume you're going to need for retirement, if you had $500,000 sitting in IRA and one or even two beneficiaries only now has 10 years to pull those dollars out and pay taxes, that could dramatically, not only do they pay out more to the government in taxes, but their own personal tax rate may drop because of that forced distribution, right, from the IRA. So where insurance can help with that is to say, okay, let's say that you go out and you get a $200,000 policy, right? So we're not huge, it's not probably all that expensive, but when you were to pass away, those $200,000 now pass to beneficiaries tax-free. When you get into age 72 and a half, when you have to take distributions, you could easily take those distributions to pay for the insurance. So you're literally taking taxable to pay for that. But even prior to that, you then say $200,000 tax-free. Now your estate is either going to pay for those taxes, if you will, at a much lower per month cost. Let's just say it's, I don't know, $65 a month. Who knows what the number is, but it's dramatically less than the 200 grand in taxes that you're going to have to pay, or the estate pays, right? All of this is just to illustrate, though, that insurance can and should be at least thought of more than just trying to protect you or your specific health. As a financial tool, it can get really creative and it's legal. But certainly this is obviously then where working with someone who looks at the whole picture And even as an advisor, I say to folks, I don't need to hold all of your money and manage it all. I just need to know where it's at so that we can see all of those moving pieces, right? Because I don't want to miss something, or I don't want to duplicate maybe something of an investment you're doing elsewhere, right?
I
That's
just wanted to, oh,
Yep.
sorry. I just wanted to jump in with a clarification when you said that the beneficiaries inherit the, let's say in your example, the $200,000.
Uh-huh.
It would be tax-free if it's a death benefit.
That's right.
But if
That's right.
they inherit it in like a 401k, they
It's
would have
taxable.
to pay taxes on that as income.
That's right.
And so I just wanted to clarify that. I wasn't sure that was
Yeah, very good. Thank you very much.
Thank you.
You bet. So in leading to kind of the next slide, if you will, Marche, this is kind of stepping in where the financial person brings certainly less emotion to the plan than you. Most people say, well, it's just money. It's not that emotional. I said, well, I promise you in the last quarter, when people's statements have come up, you've had some sort of emotional response to whether or not your accounts were up or down to differing levels, right? But typically we also bring that objective point of view, and we're able to see potential blind spots or duplications just because that's what we do. In the end, my main goal is to make sure, I think, that most people don't want to be a burden on their family, whether it's financially or medically. And so some of these conversations force that discussion with not only with you and, if you have a partner, but also, your beneficiaries, and the clarity that says, hey, I've got these kinds of plans in place. Just know that either, hey, John's my guy, give him a call, or that person, right? It allows everybody involved to feel much more comfortable when things, and they will, take a left turn. And you've thought through most of them, and that's fantastic. So some of the typical blind spots, next slide, is usually then, of course, that cost of living will increase. And certainly medical costs are, in the last 2 years, the greatest example of that. And that's certainly not going to slow down. But projections can certainly help with that, to say, and you can move the sliders, if you will, around to say, well, if medical costs go up 15%, maybe for the next 5 years, what's that look like? What's your need to be? What is that target we need to be? Go to the next, please. These questions, really, as you see here, sets that target. And we take in a very objective perspective, but we look at it from a much longer runway. Then we just say, these are the goals that I want to hit. I want to cover healthcare. I want my kids to have something. I want my alma mater to receive something, or whatever that might be. Then it's easy to back that up and say, okay, as it currently sits today, you have these accounts, whatever they might be, and I can project them 10 years down the road. Then the conversation goes to, when we start to pay for these, when you are 65, when you're 75, if we pull from the tool of the IRA, this is going to be your tax liability. If we pull from a Roth, this is it. If we pull from, these different assets, this is how either your money continues to grow and we pay for things without, taking it to the bone, or realistically, as it sits today, your standard of living probably needs to be here, right? That's a very unvarnished conversation to have, that I try to have with everyone so that we at least understand where we are today, especially if you have a number of years left to work. Okay, well, then we've got a roadmap. And if you're one of those fortunate few in America where all of those buckets are taken care of, and all of the concerns are taken care of, well, then we start talking about, where do we start giving it away? When do we start giving it away? How do we give it away in the most tax efficient way so that certainly it benefits you, as it should, right? You did all the work to get it. We certainly always have to pay the government what they're owed, right? That's biblical. It's fine. There's nothing wrong with that. But there are ways to do this where your dollar can go furthest. That is absolutely part of the plan. And when you become certain ages, there are, when you start having to take required distributions, there's a way to then take those distributions, give them away tax-free. You didn't pay tax. The people that receive them don't pay tax. There's lots of different ways to then talk about your buckets of assets and say, how can we make the most good? As well as, how do I pass this on maybe to future generations in my family? And do we set up estates or not? Is it a simple will? All of these conversations certainly go to make what we start out as, John, do I have enough money to make it into retirement? Most times you do. My bigger question is it going to get us through retirement? So as the advisor, I always say, like in the beginning, right? You're going to have a lawyer sometimes, you're going to have a CPA sometimes. Maybe you do, maybe you don't. But someone needs to run the entire picture on your behalf. And sometimes those professionals work behind the scenes and they bring you the solution even without you even knowing. And that's fine. That's the way it should work. I work often with the CPAs and others just as a simple phone call once I have, certainly permission to make that connection and say, hey, there's this like tax time, perfect time right now, whether you need a write-off or you had certain assets that were sold in the year, whatever that might be. It shouldn't be you in the middle making that conversation. There should be that quarterback that says, okay, this is where we're going. This is how we're going to get there. And because you've set the goal as the overall coach, well, it's up to me then to deliver, right? Or your financial advisor. And you may have more than one, and that's okay too. But certainly there needs to be one that sees everything and sets the tone for the entire team. Along with your financial advisor then, so for the last screen, when you start talking about that legal conversation of how do these assets not only work together, but how do they at the end of life get distributed in the best tax-free way so that all of that hard work that you've done actually transfers? Well, then you're talking about a power of attorney, and there's one certainly for financial. Sometimes it's different for medical. Sometimes the reason for that is because personalities, maybe someone's better understanding or handling medical conditions, or someone has a better financial understanding, or it's just the ability to remove yourself sometimes from the medical situation you might find yourself in. Somebody else might be able to say more clear-eyed, no, I know mom or I know dad wanted this medically, although it's hard, that's where we're going to go. So it may not always be the same person, and same with financial. And it certainly is when I ask folks to talk to their family. It's absolutely an honor if you've all been asked. It's 10 seconds of like, wow, I feel really honored that person would think that highly. But if you've also helped anyone in your family, you also quickly understand it's a lot of work And as an advisor, when someone becomes the executor of a will, for example, I try to bring all of the beneficiaries together and define what that role is so that there aren't misunderstandings. Because I think we all think the executor of a will, for instance, has the ability to make all these choices. And if you've been in the role, you understand that's not the case. You are literally there to execute whatever is legally determined already by that person. And so it's just as, again, as that quarterback for now the next generation of the family, is to bring everybody in and say, listen, this person was chosen, don't know why, doesn't necessarily matter at this point, but don't necessarily read too much into it. It's not a personal connection always. It's just this person's deemed to fulfill those wants, and everything is legally going to be, printed out with statements for everyone to see. So have grace with that person who was also going through that loss, and understand that person's doing a lot of work for the benefit of everyone. And as a financial person, in that conversation, that I think is something that you should expect for your immediate family, because you should, and that just makes it easier for everyone. I guess, I'll kind of stop there and kind of open it for a question if you have questions. I don't want to belabor the point. So,
All right, I do have some questions here.
great.
This is a great one about long-term care policies.
Mhm.
What if someone doesn't want to pay for a long-term care policy, but instead wants to self-insure through their investments, other ways? Is that a viable option? And typically, how much these policies pay, so how much to put into that kind of self-insurance fund?
Sure. Fantastic question. So self-insuring, fantastic. If you've got the means, by all means. The best thing about that is you retain the control of the asset, and you can liquidate it. You can use the tax benefit potentially by selling and moving the assets around to your own good. The challenge to that is that if it's you specifically, and if it's your assets, most likely you're probably not the one making those decisions. So if you're going to self fund those things, I would recommend making sure that you have a very clear plan, whether it's through an advisor or written, as to how you want that to go, still in somewhat broad terms, but just sure you try to document, because it would be a bummer to do all of that work and then you're thinking, oh, I have a certain tax strategy and all of that, and it doesn't come to fruition just because it wasn't relayed on. I'm all about, if you have the funds to do that, that's great. Again, insurance, I'm for it when it makes sense, and it doesn't always make sense for everyone, both from a personal opinion you may have, or maybe you medically can't get that insurance. That's okay too. It just means that path is slightly different. So what is a number? Right now, monthly costs are give or take $7,000. This is, again, a lot of industry generalities, but it's just for regular stay and care is about $7,000 a month. And if you were to have additional medicine or additional levels of care, whether that's daily visitation by a nurse, or you're going to have some sort of specific rehab, that kinds of things, add on to that number. Okay, so simply, let's 50 grand a year. Long-term care, the actuaries, when you buy a policy, typically the payout is for 18 to about 26 months. And then typically the insurance runs out. Okay. It's kind of, again, across the board, because statistically they're trying to shoot for that 90 to 95% of needs. Also be aware that on the front end of a long-term care policy, there's always 3 months before you can use the policy. So regardless, again, that kind of goes back to your emergency fund. Know that you and your assets and your family will have to pay for care for 3 months before the insurance kicks in. It's just the way the industry works. They're not trying to hide anything. I just want to make sure that you understand kind of the broad way things work.
We had another good question. What about life insurance with long-term care versus an annuity with long-term care? Do you know much about that? Can you speak to that?
So a life insurance, are you talking, well, I'll say if it's a whole life policy of insurance versus term, right? So whole life means it's usually good to your 95, 100, 110. And at some point, typically those are sold with the idea that that's either going to generate you income, typically as an income rider, or it's just a whole life policy that theoretically is supposed to grow, in the next 30 years. Usually extremely conservative, but it also says it's guaranteed, right? So you don't lose your value typically with the whole life policy. Pairing that with long-term care, honestly, because the industry has changed so much, and a lot of times those whole life policies, for example, have become somewhat antiquated. We tend to roll the asset value of the whole life to actually help pay for, if not completely pay for, a long-term care policy, because you actually then get the best of both worlds. You get the healthcare coverage, which you need. You still have a life benefit, some sort of death benefit, right? And it still has usually the ability to grow in its value. So we'll take, if we can, that asset as a whole life and pair it / convert it with what's called a 1035 exchange. Doesn't cost you anything. It just happens on the back end with paperwork, and away you go. The only caveat in all of that, again, it goes back to, because you're creating new insurance, is whether or not you can qualify medically for the long-term care. So I hope that answers it. With term, the bigger question is, how long is your plan to keep the term insurance to begin with? Typically, when you hit about 60, those term rates go through the roof. And kind of back to the original question about self-insuring, it's probably better to not pay the $400 to $800 a month for term insurance, even if that means you're taking the same dollars of $400 a month and you're putting it into a Roth, or you're putting it into something else. Just your return on that investment is better utilized elsewhere.
And they did ask about if there's annuities with long-term care, if that can also be an option. No worries.
No, it's very good. So annuities are very similar to like a whole life in this strategy. So an annuity, again, there's some sort of underlying value that probably over the years has grown. And so with an annuity, there's always a monthly charge. It's just at some point, that underlying asset bucket of money, let's say after 15 years, you now have 20 grand sitting in there. That's actually creating a dividend that's now paying your monthly cost. It's still always there. There's still always a cost. It's just, it becomes, as they say, fully funded or self-funded. So it's paying for its own self. A lot like whole life. The annuity, again, the main purpose typically for that is when it's sold, is to create some sort of income stream down the road. If you're not going to need that income stream, then that might be an asset that then you roll into a long-term care, or down the road, maybe you keep the annuity, but you turn on the income, meaning it's generating 500 a month or 1,000 a month or whatever that might be. And that then pays the premium for that long-term care. So depending upon exactly that annuity, and I'm telling you, there are literally thousands of different types of annuities. And if it's been more than 3 or 4 years since you've looked under the hood, it's certainly free to have that looked at. And I would recommend, even just for you to understand what are your costs today, anything more than about 10 years old for an annuity really probably should be looked at for your costs and your return as an asset. You might find better options, but it's certainly a great conversation.
Well, thank you so much. I do have a couple more questions here.
Yeah.
I do want to encourage people to go ahead and add your question, and we'll try to get to them. If we don't have time, we'll certainly have someone reach out to you after today's event. So can you talk a little bit about Social Security and waiting to withdraw until the max benefit? I've heard that's a good thing.
It's a huge thing, and it's a great question. And there are some on both sides of take it or don't. I'll start with just a simple story. Not the financial side, but I've seen many times when you have put in Social Security for 30 or 40 years, you finally become the age of, right, 60, 62, 65, and you can now take that. There's been a number of stories that I'm aware of that maybe that person passes away when they're 68 or they're 70, right? And they were waiting to take that. And then all of those years of putting into it, you literally don't get anything from it. From a numbers perspective, there is a number of years of receiving the benefits that it takes for you to receive all of the money you've put into it. Does that make sense? So for you to return your own money, let's say it takes 15 years. The later that you start that, the later you'll get your money back. And what you leave on the table, quite honestly, goes to other folks. That's kind of the negative way of looking at it to some degree. But maybe the positive spin to that is, it's yours, take it. If you look at statistically going from 62 to 65, the rate that your monthly changes between those 3 years, it's quite honest, it's very nearly the cost of living difference between. To go from 62 to 70, there is a growth of the asset. The bigger question is, what can you do in those 8 years if you were to take those dollars out and invest it yourself? And that's just a numbers game. Traditionally, or I guess historically for me, I've had a number of folks that we can do much better with your assets than somebody else managing your money. So if you don't need it, why not take those dollars, pay the taxes on it, and immediately invest it if you're not going to use it? Either way, it's in your pocket. I hope that answers the question.
Yeah, thank you so much for that feedback there. One last question before we have to end. How much education can you expect from your financial advisor, such as, what we've been doing here today, to understand your investments and your financial plan?
That's a very loaded question, and I appreciate it. I personally think you should be able to expect all education, meaning, if you can't walk away from working with your advisor and fully understand what you have, how it works, then maybe you've outgrown your advisor. Meaning, not everyone can understand the geek level, and you shouldn't, right? That's like me expecting a wedding wedding planner and understand that I'm going to say all the details of how this amazing day happens. And it's like, no, I pay you so that it goes well, but I fully understand when we're going to go, what we're going to do, and how this is going to play out. Your finances should be the same. I should understand the difference between what's taxable and what's not. I should be able to understand insurance can play a certain role, or I understand that simply maybe kind of a broad 30,000 foot level, that I have 5 different buckets of money and each one covers a certain concern. Whatever level of understanding that you want, that's what you should get, period. And if it's not that way, find a different advisor, even if that means creating a little bit of short-term pain and uncomfort or discomfort for you to move things or whatever. In the long run, this should not be, your money should not be something that literally keeps you up at night. Let somebody else do that work so that you can worry about enjoying your life. That's about all I have.
Thank you so much. I was just about to say something and realized I was on mute. Well, folks, I appreciate everyone being here. I appreciate John for being here and sharing this presentation today, and for the organizations that have made this webinar possible. Thank you so much for attending. Look for an email soon with the link to the replay of this event, and you're welcome to share that with friends or family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Bye, everyone.